Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Cronemeyer. I'm Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy, and thanks for all the listeners. Jumping on the calls, volatility is still name of the game, and we saw the S&P fall about 1.5%, followed by the Nasdaq up about 2.5%. But on the flip side, we saw the Russell 2000 small cap rising about 1%. What sectors did what? We saw energy, real estate gain just over 3%. Well, we saw technology, consumer discretionary. Remember, they were the leaders, 23 and 24. They fell about 3%. Semiconductors and Nvidia, AMD warned on some steep charges caused by a drop of about 4% in that index itself, putting a lot of pressure on that tech sector. If we look at Treasury Yields, the 10-year yield dropped about 16 basis points to about 4.33%, while we saw gold rise about 2.5%. That's been the safe haven of late, and then followed by, oil prices actually increased about 3.5. Now, we'll be looking at Fed Chairman came out making some comments about tariffs and how that could push inflation higher, weakening growth, weakening employment, sending the risk assets lower. If we look at some economic data, we saw retail sales increase about 1.4% in March. Consumer sentiment numbers down. Worried about inflation, unemployment, which hasn't ticked up yet. We'll see if that does. And then the overall just concern with the volatility always puts anxiety. It unnerves the market, unnerves the consumer. Obvious why that should do so. Then we'll look at manufacturing survey. That was a bit soft for new orders, increased prices paid for the index. Then we look at consumer builder confidence. That remained pretty negative with housing starts dropping a good bit. Going to the international markets, we saw the European Central Bank reduce interest rates about 2.25 rates to about 2.25%, and then the Bank of Canada kept those pretty steady at about 2.75. UK CPI retreated a bit in March, signaling some cooler areas for the labor market. And then over in China, we saw the first quarter growth and March retail sales exceeding some forecast. Now, going into this week, what is it going to be about? Well, obviously, it's going to be about market volatility, potential stagflation, recession, everything that we've been concerned about before, tariffs. But really, it's going to be about earnings. We are going to get some economic reports showing a global flash PMI. Some FOMC members will be coming out with some appearances around. But I think it's really going to be about inflation. We'll be looking at that flash PMI, and then earnings. We'll be looking at Alphabet, Tesla, Boeing, IBM, PepsiCo, Intel, Texas Instruments, so on and so forth, giving us some clues, some indication on how the companies are managing and what they might forecast for earnings, since really we got a moving target with tariffs here. We just don't know from day to day what's going to happen. Some economic data, some new home existing sales, durable goods orders, and some revised consumer sentiment and inflation expectations will be rolling out. Jeremy?
Thanks, Graham. So I had a question for you. So I know we've been, talking about volatility lately, but a lot of our, listeners and clients are talking about the volatility and if they should get in and out, get all out, go all in, back and forth. What do you see to that?
Yeah, no, and I know we talk about it a lot with our team. I know we brought it up many times over the years. Really that's kind of a losing battle. It's kind of trying to catch lightning in a bottle twice. I think we talked about bringing up some slides to comment on that. And I get the idea behind it, but it's so hard to get it right getting in and get it right on getting out or vice versa. So here we just brought up a report. I think this one's from either Vanguard or American Funds, but it's showing missing the best days of the market, which often cluster with the worst days of the market, can be costly. So we took $100,000, we invested it in 1888. Look 1988 and looked at it all the way to 2024. And if we stayed invested, that'd be worth about 4.9 million. Now, if we just missed 10 of the best days, our return dropped 52%. 52%, that's over $2 million less return. If we missed 20 of the best days, we would have missed 72% of the overall performance, right? 1.4 million, only be worth 1.4 million. And then if we missed, I think it's 30 of the best days, we missed out on 82%, or we dropped 82%. The investment would only be worth about 0.9 million. A dramatic drop. So it's not maybe all getting in and out, but it's understanding what you need in the short, intermediate, and long term, and positioning those in areas of ultra safety and security, like money market CDs, immediately liquid and available assets without much risk or risk at all the way to intermediate, shorter intermediate term bonds, start getting the high dividend stocks going in the long term, the market, small cap, mid cap, international. So I think it's not all in and out. It might be a little bit of that. And then we even brought in and we said, okay, what about the S&P index total return? And then we said, okay, if we looked at markets going back from 1929, and we said market declines of at least 15%, what was the subsequent 12-month return? And it might be really surprised you. Look at all these periods over time, right? The market's always going to have drama. But look at this. The average 12-month return after a street drop was 52%. Now, that's taking in the drop and going back, but it's 52% because we don't know, right? So stay in the course. Again, I don't think it's about getting all or out. I think you can always position some assets to be ultra mindful of preservation, but not all in and out. I hope that helps our listeners a little bit as we go through these unnerving times.
Gotcha, Graham. We always appreciate the information, the expertise, and thank you to our listeners. We do have our retirement planning today classes coming up, starting on Saturday, March 3rd and 10th, and then also on Tuesdays, March 6th and 13th. So if you want more information about that, you can call the office or go check out our website. We look forward to seeing you next week.
Take care.